The price hasn't moved in weeks, your portfolio is flat, and every analyst you follow is either screaming buy or quietly deleting their predictions from 6 months ago. But here's what nobody is pointing a camera at right now. While that number on your screen sits perfectly still, the actual structure of who owns XRP and who controls its future is being rewritten at a speed the market has never seen before. This is not price action analysis. This is a structural autopsy of a market that is quietly changing hands. And by the time I finish walking you through this data, you won't be looking at the price the same way again. But before I get to the part that most analysts refuse to say out loud, I need you to understand one thing first. Welcome back. This channel exists for one reason: to translate what the financial system is actually doing into language that gives you a real edge. Not hype, not hopium. Just the cold forensic read of the data, the filings, and the on-chain mechanics that institutions use to position long before the public catches on. Today's briefing is built around one thesis: that the XRP market has quietly split into two separate realities, and most retail investors are living inside the wrong one. If this is the level of analysis you've been looking for, you already know what to do. And if you want this delivered to you every time the signal shifts, the subscribe button is right there. No pressure. Now, let's get to work. Here's the hard truth that 90% of people watching this chart are missing. The price you see on Binance, on Coinbase, on any exchange, it's not the price that institutions are paying. It never was. When a firm like Franklin Templeton or Bitwise needs to acquire hundreds of millions of dollars worth of XRP, they don't open a retail account and start clicking buy. They walk through a different door entirely. It's called an over-the-counter desk, and OTC desks don't show up in your order book. They don't trigger a candle on your chart. They source liquidity directly from large holders, from custodians, or from Ripple's own strategic reserve position. And they settle those trades completely off exchange. What this creates is a two-speed market. On one track, you have retail price discovery, the number you're obsessing over every morning. On the other track, you have institutional acquisition, happening in the dark, at scale, with no signal visible to you until it's already done. This isn't a conspiracy. It's standard operating procedure for any asset class that manages serious capital. The question you should be asking is not why is the price flat? The question is why are institutional players paying a premium to acquire XRP quietly while the public price stays depressed? And the answer to that question is where this analysis gets uncomfortable. Because when you follow that thread, the math stops being theoretical and starts being structural. And once it's structural, the math doesn't need your opinion to be true. Let's do the math that the crowd isn't doing. XRP has a fixed total supply of 100 billion tokens. That's not changing. Of those, approximately 57 billion are in current circulation. Now here's where it gets precise. According to current exchange reserve data from CryptoQuant and Glassnode, the total sellable supply sitting on centralized trading platforms has dropped to approximately 1.7 billion tokens. That is a 7-year historic floor. We have not seen sellable supply this thin since 2019, before ETFs existed, before institutional custody infrastructure existed, before any of this was a regulated conversation. At the same time, total assets under management across XRP-linked investment products have crossed $1.5 billion. Think about what that means in structural terms. You have $1.5 billion in institutional demand pulling against a liquid float of 1.7 billion tokens. Those two numbers are not operating in separate universes. They are on a collision course. And when $1.5 billion in managed demand begins seriously pressing against a 1.7 billion token floor that is itself shrinking by the week, the exchange price isn't a reflection of value anymore. It becomes a lagging indicator. The price discovery we see on exchanges is being bypassed by buyers who don't need the exchange to function. They are building a position beneath the waterline, and the surface hasn't moved yet because they don't want it to. Not until they're done. The math doesn't need a prediction. It is already a ledger entry, But math alone doesn't move markets. What moves markets is when the biggest players in the world start acting on that math, and that's exactly what's happening right now. Consider this data point from the 2026 institutional filings. Bitwise and Franklin Templeton have recorded 55 consecutive days of net positive inflow into their XRP products. 55 days, no interruption, no reversal. In institutional terms, that is not a trade. That is an infrastructure build. You don't run 55 consecutive days of net inflow if you're looking for a quick arbitrage exit. You do that when you are laying pipe, when you are creating a position designed to last not through the next candle cycle, but through the next decade of global financial rails being rewired. Now consider what happened in February during the broader crypto market correction. Bitcoin recorded $260 million in net outflows from institutional products in a single week. During that same period, XRP captured $63 million in fresh institutional capital. That's not a small divergence. That is the signature of smart money, treating a market dip not as a risk signal, but as a restocking opportunity. While Bitcoin's institutional holders were reducing exposure, XRP's institutional holders were accelerating theirs. That separation, in the middle of a correction, is the clearest institutional signal this market has produced in over 2 years. I want to stop here and ask you something directly. Do you think the institutions are already fully positioned, or do you think they're still loading? Drop it in the comments. One word is enough, because the answer changes what you do next. A lot of people find this channel right before things start moving. If you're one of them, make sure you're still here when they do. Now let's talk about what actually triggers the next phase. Because accumulation alone doesn't produce a price move. What produces a price move is the activation of demand that has no alternative. And in 2026, that activation has a very specific schedule. The first pillar is RLUSD. Ripple's dollar-pegged stablecoin is not a speculative product. It is a settlement instrument designed specifically for bank-to-bank high-velocity transfers across the XRP ledger. When RLUSD adoption reaches critical mass within institutional payment corridors, every transaction generates burn. Every transfer consumes a fractional amount of XRP, not as a fee, as fuel, as the operational grease that makes the rail function at scale. The moment that burn rate begins compounding across dozens of financial institutions running concurrent settlement flows, the supply math we discussed earlier stops being theoretical and becomes a daily reality. The second pillar is the bank charter wave. Ripple's push toward federal banking infrastructure in 2026 is not a press release strategy. It is the groundwork for a mandatory buy phase. When a regulated financial institution requires XRP to function as a bridge asset in their settlement architecture, they are not buying it because they like the chart. They are buying it because the infrastructure demands it. That purchase is not optional, it's operational. And the third pillar is the Fortune 500 exposure wave. By 2026, approximately half of the world's largest companies are expected to hold tokenized assets or formalized crypto strategies. When treasury allocation from legacy corporations begins flowing into digital asset infrastructure, and the primary settlement rail for cross-border digital payments is the XRP ledger, the demand does not require a catalyst. It requires supply, and the supply is already running out. But the window to be positioned before this demand becomes mandatory is shrinking faster than most people realize. And that's what I need you to see next. We are currently staring at a 7-year low for sellable XRP supply. 1.7 billion tokens on exchanges, a number that hasn't been this thin since the pre-institutional era. But that number alone doesn't tell the full story of what's happening at the wallet level. On-chain data from recent weeks reveals 2 parallel movements that together explain exactly where this market is heading. First, wallets holding under 1,000 XRP are leaving the active network at accelerating rates. The small retail holder, the person who bought a few hundred tokens on a whim and forgot about it, is being shaken out during periods of price stagnation. Their position isn't disappearing, it's being absorbed. Second, and this is the critical data point, accumulation class addresses, wallets that add to their position consistently regardless of short-term price movement, spiked 51.5% following the recent dip to $120. For every retail investor who sold their frustration into the market, a structurally patient buyer absorbed it at a discount. This is not coincidence. This is distribution mechanics at work. When you pair the drain in exchange reserves with the spike in accumulation class address activity, the picture is not ambiguous. The liquid supply is migrating from hot exchange wallets into cold storage, into institutional custody vaults, into ETF reserves where it is locked, and where it cannot return to the open market without a seller making a deliberate, coordinated exit at a price far above where we are today. Once a token enters a multi-signature institutional vault, it doesn't come back to market for a 10% gain. That token is gone. And as the faucet of available supply slows to a drip, even a modest institutional buy order becomes a high-pressure event on a near-empty exchange order book. The door is closing, and the ones who understand this are not waiting for confirmation. I know some of you are feeling the weight of that right now. The flat price is real. The doubt is real. And I want to address two specific concerns that I hear consistently from serious holders, because they deserve a straight answer, not a dismissal. The first concern is the escrow. Ripple still controls approximately 39 billion tokens in a scheduled release of 1 billion per month. The valid worry is that if institutional demand doesn't scale fast enough, that supply hits the open market and creates a permanent ceiling. Here's the structural reality. Ripple has historically relocked the majority of each monthly release back into new escrow tranches. The operational supply that actually enters circulation is a fraction of the headline number. And as bank charters and RLUSD adoption scale, the demand side of that equation grows faster than the release cadence. The escrow is a risk, but it is a risk with a known schedule, a known history, and a demand-side counterweight that is measurably growing. The second concern is the RLUSD velocity trap. If banks stick to traditional rails or private ledgers, and RLUSD fails to gain real-world settlement traction, the bridge asset theory softens. That concern is legitimate. This is not a guaranteed outcome. Anyone telling you this is risk-free is not an analyst. They're a salesperson. Trading and investing in digital assets like XRP involves significant risk, including the possible loss of principal. Nothing I present here constitutes financial advice. Always conduct your own due diligence. What separates the informed holder from the speculative one is the ability to distinguish between a risk that kills the thesis and a risk that tests it. The RLUSD adoption timeline is a test. It is not a eulogy. Ripple is no longer in a courtroom defending its existence. It is in boardrooms competing for market share in a $4 trillion payments industry. That transition from legal survival to commercial execution is the single most important structural shift in this asset's history. And it brings me to the only thing I want to leave you with today. Something I don't say lightly. Here is what you stayed for. The price of XRP is not the signal. The distribution of XRP is the signal. And that distribution, right now in 2026, is telling a story that the price hasn't told yet. With only 5.1 million active wallets globally, XRP is more concentrated, more structurally scarce on a per capita basis than almost any Tier 1 financial asset in history. The wealth tiers on this ledger are not determined by how high the price goes. They are determined by how much of the free float you hold before the institutional lockup reaches a terminal floor. To sit in the top 10% of this network's participants, you need roughly 2,500 tokens. To reach the top 1%, that number is 50,000. As the institutional free float lockup accelerates, these thresholds are not just benchmarks. They are the actual coordinates of financial positioning in a supply-constrained, infrastructure-grade asset. History does not reward the people who waited for certainty. It rewards the people who understood the structure before the price announced it. The ledger does not care about your sentiment. It does not care about social media fear. It does not care about the weeks of flat candles that shook out the impatient. The ledger only records who held, who sold, and who accumulated when the room was quiet. You've now seen the full picture, the structure, the math, the institutional mechanics, the risks named and measured, and the distribution reality that most investors never pause long enough to read. So here's my question for you. Now that you've seen all of it, what is the one signal you are personally watching most closely heading into the second half of 2026? Tell me in the comments. I read every one. If you want this level of forensic analysis every time the signal shifts, you know exactly what to do. I'll be breaking down the next phase of this in the upcoming video. Stay positioned, stay patient. In a market driven by emotion and noise, the edge belongs to those who stay anchored to data and composure. The math doesn't lie, and the structure is almost complete.